Segment 1. The paradox of winning. Imagine walking into a quiet, marble-floored lobby of a private bank. Sunlight reflects off polished surfaces and a trading screen glows softly in the corner. You check your portfolio. $100,000 has grown into $1 million. You did what many dream about. You made the right decisions. You stayed patient when others doubted you. The account changed, the scoreboard changed, your story changed.
Everyone around notices. Colleagues, friends, and clients suddenly pay more attention. They ask what you own. They ask what you see next. They treat the number as proof you have figured life out.
But here is the first hidden truth. People confuse visible wealth with invisible freedom. Just because the number is large doesn't mean your life is easier, calmer, or more flexible.
Something strange happens. You still wake up checking markets. You still feel tension when prices move. You still hesitate to step away from work. You still feel dependent on the next quarter, the next earnings report, the next market move. You won, but you still cannot leave the table.
That's where most people are shocked. They assumed money would remove pressure. Instead, it sometimes changes the shape of pressure. Bigger portfolio, bigger stress, bigger lifestyle, bigger tax obligations, bigger fear of losing status, bigger need to keep the machine running.
The central mistake of modern finance. Wealth and freedom are not identical. One can rise while the other stays flat. One can rise while the other falls.
Wealth is a resource. Freedom is a condition. Wealth can buy time, reduce fear, expand options, but it can also create new chains if built in the wrong structure.
People assume growth always feels lighter. Sometimes growth feels heavier. That extra million doesn't always make life easier. It can make obligations, dependence, and pressure bigger.
If your peace depends on one stock, one bonus, one employer, one market trend, or one monthly number, fragility remains, even if wealth increases.
Most people optimize for scoreboards others can see: net worth, income, house, social proof. Those metrics can be useful, but they are incomplete.
Strangers cannot see the hidden scoreboard. Sleepless nights, oversized positions, fear of reducing exposure, lifestyle bills, stress that rises as the account grows.
The hidden scoreboard is more important. Can you say no? Can you pivot? Can you survive a bad year? Can you think clearly without panic? Can you sleep without checking prices?
Those questions reveal true quality of life. They show whether wealth is serving you or whether you are serving the wealth structure around you.
And here's the signature line for this episode. Your net worth can go up while your choices go down. That sounds backward, but it explains the paradox at the heart of modern success.
Consider a concentrated investor. One winning position dominates the portfolio. On paper, success increased. In practice, a single earnings report now controls mood, confidence, and future plans.
Consider a founder. Company value rises sharply, headlines celebrate. Yet nearly all personal wealth sits in one private business with no clean exit. Wealth expanded. Freedom stayed delayed.
Consider a high earner. Salary doubled. Expenses tripled. Bigger home. Better neighborhood. Premium lifestyle. Now they need the income more than ever. Richer outside. Tighter inside.
Different stories. Same pattern. The number improved, but the structure did not.
Most people chase money believing it will buy security, calm, respect, space, control, time, or choice. But if money arrives without these things, people feel trapped instead of free.
They may feel grateful, but pressure remains. They may feel victorious, but still constrained. They may feel successful, but still dependent.
Confusion comes from mismeasurement, tracking one scoreboard and ignoring the other.
Real wealth is not only what you own, it is what you can choose, what you can pivot, what gives you room to breathe, to act, and to think long-term.
Many people spend 10 years building a number, only to realize what they really wanted was breathing room. Not applause, not screenshots, not one more double, breathing room.
Frameworks matter. If you define success badly, you can win the wrong game for a very long time.
So, the question for this episode is simple. If bigger wins do not automatically create freedom, what keeps people trapped after success?
The first answer is brutal. Sometimes making money is easier than getting out with it.
Next segment, the illiquidity trap.
Segment 2, the illiquidity trap. One of the oldest traps in finance sounds almost impossible the first time you hear it. You can make money, yet still be unable to use it.
That is when people learn the difference between being rich on paper and being free in real life. They thought they owned wealth. What they really owned was a difficult exit.
Illiquidity means turning value into usable cash is slow, costly, uncertain, or impossible when you need it most. It is not always visible during good times.
Many people assume wealth is simple. If an asset is worth $1 million, they believe they own $1 million. But sometimes they own an estimate. Sometimes they own a price that only works for a tiny amount. Sometimes they own something valuable with no easy buyer.
Sometimes they own a beautiful number that disappears the moment they try to sell it.
Market value and exit value are not always the same thing. Market value is what the screen suggests. Exit value is what you can actually realize after size, timing, fees, taxes, and available buyers.
Think about a small stock that rose sharply. The chart looks impressive. But if daily trading volume is low and your position is large, selling can push the price down. The bigger your success, the harder the exit may become.
You became the market. That is a brutal surprise for people who thought the quote on screen was guaranteed reality.
This also appears in private markets. A startup employee may hold shares valued in the millions after a funding round. Headlines call them wealthy. Yet there is no public market, no immediate liquidity, and no certainty of when cash can be accessed.
The wealth may be real in theory, but delayed in practice. And delayed freedom often feels very different from actual freedom.
Paper millionaires still asking for vacation approval. That sentence explains more than many valuation models.
Real estate offers another version. Property values can rise strongly, but converting that value into cash may require months of selling, repairs, negotiations, fees, and uncertain pricing. Valuable does not always mean available.
Private funds can face the same challenge. During calm markets, investors focus on returns. During stress, many ask for cash at once. That is when gates, delays, and restrictions suddenly matter.
Everyone loves the lockup until they need the key.
Crypto staking can create a similar mismatch. Investors earn yield, but unstaking periods or platform restrictions may delay access during fast market moves.
Different assets, same lesson. You do not fully own what you cannot reasonably exit.
That line sounds harsh because people want ownership to be emotional. They want the story, the screenshot, the statement. But ownership is practical. Can you use it when life changes?
Access is part of ownership. If capital cannot move when needed, freedom is reduced.
Imagine two investors. One has $1 million tied up for a year in hard-to-exit assets. Another has $500,000 liquid, diversified, and available tomorrow. On paper, the first investor looks richer. In real life, the second may be freer.
The second can relocate, start something new, help family quickly, buy opportunities during panic, sleep better. Those options matter more than bragging rights.
Liquidity creates optionality. Optionality often creates better long-term outcomes than static wealth alone.
This is why experienced operators think about exits before entries. They do not ask only how high something can go. They ask how cleanly they can leave if circumstances change.
Average investors chase upside. Strong operators study doors, windows, and fire escapes.
That does not mean avoiding all illiquid assets. Some of the greatest fortunes came from businesses, property, venture investing, and concentrated positions held over time.
The issue is not illiquidity itself. The issue is ignoring the price of being trapped. If you commit capital for years, the reward should justify the loss of flexibility.
Too many people price upside carefully and price captivity at zero.
Illiquidity also changes psychology. If money is trapped, every problem feels larger. Job stress feels heavier. Expenses feel sharper. New opportunities feel frustrating because you cannot act.
That is why liquidity is not boring cash management. It is emotional resilience. It gives room to think instead of react.
In bull markets, liquidity looks lazy. In hard markets, liquidity looks brilliant.
Because when fear rises, buyers become selective and flexibility becomes scarce.
So before chasing the next big return, ask a better question. If life changes suddenly, how fast can this asset become freedom?
Sometimes the difference between wealth and stress is not return. It is exit quality.
And even when the exit is available, another force can still keep people trapped: taxes.
Segment 3, the tax trap. Some gains are exciting when they are unrealized. They sit on a screen, lift your confidence, and make the future feel larger. Then one day you decide to sell, and reality enters the room.
The silent partner finally introduces itself. Taxes.
This is one of the least glamorous forces in investing, which is why many people ignore it until the exact moment it matters.
Investors spend hours studying charts, earnings, market sentiment, and macro trends. Yet many spend very little time thinking about what happens when profit becomes cash. That gap can be expensive.
People love gross numbers. I made 100,000. I made 500,000. I made 1,000,000. Then the real number arrives, and it is much quieter.
Gross gain and usable gain are different concepts. A realized profit may be reduced by taxes, fees, timing decisions, and structure. The headline win can be larger than the practical outcome.
This creates a subtle trap. A person knows they should diversify but delays selling because the tax bill feels painful. Another knows one position is too large but keeps waiting for a better moment. Another wants more balance but hates the idea of writing a large check to the government.
So they stay trapped to avoid pain now and often create bigger pain later.
Taxes do not only reduce returns, they change behavior.
That sentence matters. Many investing mistakes are not caused by bad assets. They are caused by emotional reactions to the cost of changing structure.
Someone holds a giant winner too long because selling feels like losing part of it. Someone delays smart rebalancing because the bill feels offensive. Someone stays concentrated because they cannot emotionally accept paying to become safer.
This is common because people mentally claim pre-tax wealth as fully theirs. They plan around it, compare themselves with it, and attach identity to it before the final number is known.
Then, when reality arrives, frustration follows. Not because taxes are mysterious, but because they were never honestly included in the plan.
They counted the trophy before paying for the table.
Strong operators think differently. They do not ask only how much can I make. They also ask how much do I keep, when should I realize gains, and what structure creates the cleanest outcome.
That mindset sounds less exciting than moonshot culture, but it often creates more durable wealth, because usable wealth is what changes life.
1,000,000 trapped in fantasy math is weaker than 700,000. That actually improves your life.
Consider two investors with identical gains. The first sells emotionally with no planning, pays unnecessary friction, and keeps less. The second plans, timing carefully, uses efficient structure, and exits with more usable capital. Same investment win, different life result.
This is why some quiet investors compound steadily, while louder investors mainly compound stories.
Markets are full of people who know how to enter and have no idea how to exit.
Another hidden effect is paralysis. An investor knows a position has become too large. They know risk is concentrated. They know peace of mind would improve after trimming. But the tax bill feels painful, so they wait.
Then they wait again. Then markets change. Then the gain shrinks, but the stress remains.
That is a brutal combination. Less profit, same anxiety.
Holding a weak structure because you dislike the cost of improving, it can become more expensive than the cost itself.
Sometimes freedom has an upfront price. Selling, rebalancing, simplifying, paying what is owed, and moving forward may feel painful in the short term. But delay can cost more through stress, fragility, and lost options.
Many people would rather protect a number than protect a life.
Intelligent investing includes tax awareness, but should not be ruled by tax fear.
That distinction is important. The goal is not to obsess over every percentage point. The goal is to align wealth with purpose. If planning can create more flexibility, lower concentration, and better sleep, then planning is not boring administration. It is strategy.
The strongest players do not complain about reality. They price it in.
Taxes are part of the game environment. Ignoring them does not remove them.
So ask better questions. If I sell now, what do I gain besides money? If I wait, what do I risk besides tax savings? If I simplify, what pressure disappears? If I rebalance, what freedom returns?
Those questions turn a tax bill into a life decision.
And once people see that clearly, another trap becomes obvious. Sometimes the position that made you successful grows so large that it begins to control you.
Next segment, the concentration trap. Segment 4, the concentration trap. Many fortunes begin with concentration. One business, one stock, one property decision, one bold bet held through years of doubt. Real wealth is often created not by owning a little of everything, but by owning enough of something that truly works.
Diversification can protect money. Concentration can create it. That is why so many big success stories start with one powerful move.
Concentration is not automatically dangerous. In the right phase, it can be rational. It rewards conviction, patience, expertise, and courage.
But concentration has a second chapter that many people ignore. The same position that built your freedom can later threaten it.
The ladder that helped you climb can become the thing you're hanging from.
This happens when one asset grows into an outsized share of total wealth, income, confidence, or identity. Then a normal fluctuation can create an abnormal life impact.
Imagine a stock that began as 10% of a portfolio. It performs brilliantly for years. Now it is 50%, then 60, then 70. On paper, success increased. In practice, one ticker now influences mood, future plans, sleep quality, and risk tolerance.
Every earnings report becomes a family event. Every rumor feels personal. Every red day feels like a threat to your future.
That is the shift from investment to dependence.
Many people miss this transition because growth feels good. Rising numbers hide rising fragility. As the position grows, they feel smarter, stronger, and more validated. They may not notice that optionality is shrinking at the same time.
Success can anesthetize risk.
Meaning the reward masks the danger until size becomes the real issue.
This is common with company stock. An employee joins early, receives equity, and works hard. The company wins. Their income comes from the company. Their career reputation comes from the company. Their savings become tied to the company.
One machine feeds the whole life. Looks powerful from outside, feels risky from inside.
If the company weakens, several systems can be hit at once. Income, portfolio, confidence, and future options. That is stacked dependence.
Founders often face an even stronger version. Their wealth may exist almost entirely inside one private business. Their name is tied to it, their status is tied to it, their daily schedule is tied to it. Success is visible. Flexibility is limited.
Many founders built castles they cannot leave.
Public market investors can experience the same psychology. They buy one great company early, it changes their financial life, and then selling feels emotionally impossible.
Logic says, reduce risk. Emotion says, this winner made me. Logic says, diversify. Emotion says, what if it doubles again? Logic says, protect freedom. Emotion says, stay loyal to the source of success.
Gratitude is beautiful, but gratitude is not a risk model.
Concentration creates a difficult paradox. The same conviction that helped create wealth may later block the decisions needed to protect it.
That is why seasons matter. Early in life or early in a thesis, concentration may be the tool that creates escape velocity. Later, diversification, liquidity, and simplicity may become the tools that preserve quality of life.
Too many people keep using a launch strategy after they are already in orbit.
Strategy should evolve with circumstances. What was optimal at 1 million may not be optimal at 10 million. What was rational at age 30 may not be rational at age 50.
Elite operators ask different questions over time. What built this wealth? What now protects it? What now reduces fragility? What now improves freedom?
Average investors ask what might double next. Strong operators ask what could quietly break me now.
Both questions matter, but at different stages. Confusing the stages creates many preventable mistakes.
Concentration also narrows thinking. When one position dominates life, curiosity often falls. New opportunities are ignored, learning slows. Every conversation becomes about the same asset. Every future plan depends on the same outcome.
One bet becomes a worldview. That is dangerous.
Because if the bet changes, identity can shake with it.
This is why real wealth conversion matters. The goal is not only to make money, it is to turn success into stability, room to move, and peace of mind.
If one asset can ruin your peace, it owns too much of you.
Concentration can be productive. Overconcentration becomes captivity.
So ask honestly, is this position still a tool, or has it become the center of my life structure? Is it creating freedom or demanding loyalty?
Hard questions, expensive if ignored.
And even when concentration risk is visible, many people still cannot act because the next trap lives inside the mind.
Next segment, the psychology trap. Segment 5. The psychology trap. Some traps in life and investing are easy to see. You can watch a concentrated position. You can see a tax bill. You can see illiquid assets.
But some of the most expensive traps exist only in the mind.
This is the psychology trap. Wealth and freedom are not always aligned, and how you think about them can either protect or destroy your options.
A winning investment rises for years. Confidence builds, pride builds. The position starts to feel like part of your identity. Decisions stop being purely rational. They become emotional.
This is why greed rarely looks like greed. It shows up as patience, loyalty, long-term conviction, or belief.
That is dangerous because it hides behind respectable words. People say they are disciplined, but in reality, they are attached. They say they are patient, but in reality, they are afraid to act. They say they are loyal, but in reality, they are protecting ego.
An investor may refuse to trim a large winner because they tell themselves they are letting compounding work. Maybe they do. Maybe they are terrified of missing upside.
Another may hold a broken position because selling would mean admitting they were wrong.
Another may keep chasing bigger numbers because slowing down feels like giving up, even if the opportunity cost is real.
Outside behavior looks rational. The inner driver is emotional.
Many people want status more than freedom. Many want the story more than the result.
That is why wealthy people can still feel trapped. They have the money, but the emotional system around the money has control.
The market is not the only system in play. Their own mind is a constraint. It pushes them to stay longer, take more risk, or resist change.
Every green day feels like worth. Every red day feels like a failure. The system of money and emotion dominates thought.
Without understanding psychology, all other frameworks may fail. Illiquidity, concentration, taxes, they become invisible unless your mental system is calibrated.
Many people with more than enough still check prices constantly, comparing themselves to others, chasing proof instead of peace.
The number changed. The operating system did not.
Even after wealth is achieved, old emotional patterns repeat at a higher level.
Some are successful financially but never feel relaxed. Some are smart but remain anxious. Some are patient but still trapped by identity and pride.
The hardest trap is invisible because it comes from the inside.
This is why elite investors value self-awareness as much as intelligence. They use rules to protect judgment, not just capital.
They pre-plan exits, size positions carefully, define enough, and step back when ego becomes loud.
One of the most expensive phrases in investing is just a little more. Just a little more gain. Just a little more waiting. Just a little more proof.
That phrase has trapped talented people for decades because enough keeps moving if the mind is untrained.
The psychology trap is not only about greed, it is also about fear. Fear of missing out, fear of looking foolish, fear of losing status, fear of being ordinary after success.
Those fears keep people locked into situations that no longer serve them.
The solution is to recognize that emotion is not a reason to avoid action. It is a signal that requires interpretation.
The next trap often follows naturally. The investment is no longer the main issue. Identity merges with success.
That is the identity trap.
Segment 6, the identity trap. At first, an investment is just an investment. You buy shares, You take a risk. You hope the thesis is correct. Then, after it performs well, something subtle happens.
The investment stops being just a thing you own. It becomes part of who you are.
This is the identity trap. Your sense of self starts to depend on the position, the company, or the outcome. Decisions are no longer purely financial. They become emotional.
An early employee sees the stock rise 10 times. Friends celebrate. The community praises them. Selling now feels different. It no longer feels like managing money. It feels like losing status. Ending the story feels like admitting the best chapter is over.
Selling becomes a betrayal, not a transaction. Leaving the company, trimming a position, or rebalancing feels like losing part of your identity.
That is why identity can be more dangerous than volatility. Price or value moves can be rationally correct, but internal resistance dominates behavior.
A founder may stay too long in a role they no longer enjoy because leaving feels like abandoning the business that defines them.
An executive may remain tied to stock-heavy compensation because the title and package became their public identity.
A trader may obsess over a single winning trade for years because it became part of their personal mythology.
In each case, the money issue is secondary. The deeper issue is identity dependence. Who am I if I sell the winner? Who am I if I leave the company? Who am I if I stop chasing bigger numbers?
Those questions create invisible chains that prevent flexibility.
People with wealth tied to identity cannot pivot easily. Every new opportunity feels risky. Every change feels like loss.
Growth requires identity renewal. The student must stop being only a student. The founder must sometimes stop being only a founder. The trader must stop being only the trader. The winner must sometimes release the story of winning.
This is uncomfortable because identity provides certainty, social position, and continuity. But outdated identity becomes costly.
People may hold the wrong asset, stay in the wrong career, or maintain the wrong lifestyle for years, simply because the old identity feels safer than the unknown.
Elite operators understand that roles, strategies, and context must evolve. They regularly ask, what built this wealth? What now protects it? What now reduces fragility? What now improves freedom?
Average investors ask, what could double next? Strong operators ask, what could quietly break me now?
Both questions matter, but at different stages. Confusing stages leads to preventable mistakes.
Concentration also narrows thinking. When one position dominates life, curiosity falls. New opportunities are ignored. Learning slows. Every conversation becomes about the same asset. Every future plan depends on the same outcome.
One bet becomes a worldview. That is dangerous.
If the bet changes, identity can shake with it.
Real wealth conversion matters. The goal is not only to make money, it is to turn success into stability, room to move, and peace of mind.
If one asset can ruin your peace, it owns too much of you.
Concentration can be productive. Overconcentration becomes captivity.
Ask honestly, is this position still a tool, or has it become the center of my life structure? Is it creating freedom or demanding loyalty?
Hard questions, expensive if ignored.
And even when concentration risk is visible, many people still cannot act because the next trap lives inside the mind.
Next segment, the lifestyle trap. Segment 7. The lifestyle trap. Many people believe the biggest danger after success is losing money. Often, the bigger danger is quieter, needing too much. This is the lifestyle trap.
You work hard, invest well, earn more, and finally reach the level you once dreamed about. The income rises, the portfolio rises, confidence rises. Then, almost without noticing, costs rise too.
Larger home, better neighborhood, cars, schools, travel, staff, subscriptions. Every month, the obligations expand.
What started as reward slowly becomes structure. The person feels successful, but also heavier. Wealth increased, but freedom did not.
Lifestyle inflation is dangerous because it rarely feels reckless. It often feels earned. I worked hard for this. My family deserves this. I can afford it now. This is the next level.
Each fixed cost reduces optionality. Each recurring payment narrows flexibility. Every expensive habit increases dependence on future income.
A person who needs little can pivot quickly. A person who needs a lot must protect the machine. That difference matters.
This is why some people with modest wealth feel calm, while some high earners feel trapped.
High income can hide fragility. As long as money flows, everything seems stable. But if markets fall, bonuses shrink, or health shifts, the hidden dependence appears quickly.
Lifestyle traps affect investing decisions too. Those with high obligations need returns now. They cannot wait. They need liquidity now. They need markets to cooperate now. Urgency replaces patience.
That urgency drives risk-taking, often without conviction. They're not chasing upside. They are feeding obligations. The portfolio becomes a worker supporting the lifestyle.
That reverses the purpose of wealth. Money should serve life. Life should not serve money maintenance.
Social factors amplify the trap. Peer standards, comparison, and normalization raise perceived needs. Luxury becomes baseline. The next upgrade begins before the previous is fully paid for.
Income grows, dependence grows, freedom diminishes. Many people 10x their assets and quietly 10x their obligations. Then they wonder why freedom never arrived.
Elite operators understand a simple principle. Raising income is useful. Reducing dependence is more powerful.
The question to ask is, what actually improves life? What only looks impressive? What costs peace? What creates future pressure? What buys time?
Those questions matter more than brand names, social signals, or headline net worth.
Some people chase money without realizing that spending and obligations may erase the freedom they thought they earned.
Next segment, the Freedom Scorecard. Segment 8, the Freedom Scorecard. Most people measure success with one number, net worth. If it rises, they think life is improving. If it falls, they panic. But numbers alone don't tell the whole story.
You can be rich on paper, but trapped in practice. That's where the Freedom Scorecard comes in. Instead of asking only, how much is this worth? Ask, what does this create for my life?
That simple shift changes every decision. You evaluate not only returns, but liquidity, optionality, stress, dependence, and time. You look at how assets affect freedom, not just wealth.
Let's break it down into 5 categories. First, liquidity. How quickly can you turn an asset into usable money without loss? Can you sell in one day, a week, or a month? Can you exit cleanly in a crisis? Value exists only if access exists.
Second, optionality. How many future choices does this position create? Can it help you start a business, take a break, relocate, change careers, invest elsewhere? Good wealth expands choice. Weak wealth narrows it.
Third, stress level. How much mental energy does it demand? Do you check prices constantly? Does every headline control your mood? Fear around an oversized position diminishes freedom.
Fourth, dependence. How much does your life rely on this asset continuing exactly as planned? Do you need this stock to rise, this bonus to arrive, this job to remain stable? The more dependence, the less freedom.
Fifth, time freedom. Does wealth buy time or consume it? Can you reduce hours, think long-term, travel, learn, recover, be present with family? If it doesn't improve your time, it isn't fully serving you.
Score each category from 1 to 10. 1 is weak, 10 is strong. A highly leveraged, illiquid, high-stress, dependent asset may be worth less than it looks. A moderate, liquid, low-stress asset may be more valuable in practice.
This is where most people get it wrong. They compare returns. Elite operators compare life outcomes.
Imagine 2 investors. One earns 20% per year, but lives under constant pressure, checks the market daily, and cannot step back. Another earns 10% per year, but has flexible time, diversified income, and room to act. Who is richer?
Most would answer based on spreadsheets. The wiser answer, the one with freedom, control, and optionality.
Liquidity creates optionality. Optionality compounds quietly but powerfully over time.
That is why experienced operators evaluate exits before entries. They ask not just how high could this go, but how cleanly can I leave if circumstances change?
Average investors chase upside. Strong operators study doors, windows, and fire escapes.
Illiquid or concentrated assets are not bad by default. The problem is ignoring the cost of being trapped or misaligned with life goals.
The Freedom Scorecard turns abstract wealth into actionable insights, letting you measure assets through the lens of real-life freedom.
Once understood, it becomes clear. Maximizing freedom often matters more than maximizing headline returns.
Next segment, the optionality framework. Segment 9, the optionality framework. Many people spend years asking the wrong question. What can make me the most money? That sounds ambitious, intelligent, and productive, but it is incomplete.
Because the biggest upside is not always the best path. The better question is, what creates the most future options?
This is the optionality framework. Optionality means having choices, the ability to change direction, act when opportunity appears, and walk away when something no longer serves you.
It is the ability to adapt without panic, move without breaking your life, and preserve flexibility across time. This is one of the highest forms of wealth, yet many people ignore it.
No one posts screenshots of flexibility. Nobody celebrates the ability to pivot. Nobody shows a balance sheet of time and freedom. But these things often matter far more than an extra percentage point of return.
Imagine two paths. Path 1 offers maximum upside, high status, and social proof, but also concentration, stress, dependence, and pressure. Path 2 offers moderate returns, low stress, high liquidity, and room to pivot. Many automatically choose the first. Elite operators study the second carefully.
Why? Because a good option today can create 10 better options tomorrow. Liquidity lets you buy during panic. Time freedom lets you build a business. Reduced stress improves judgment. Geographic freedom opens opportunities. Lower dependence creates courage. Optionality compounds quietly, invisibly, but powerfully.
That is why some people with lower headline wealth outperform wealthier peers. They are freer, more adaptable, and better positioned for new opportunities.
Optionality is the opposite of fragility. One income source, one giant position, one title, or one story about yourself can make you dependent. If any one thing breaks, everything shakes.
Many people call this success because income is high, but structurally, it is risk. Wealth without optionality is expensive captivity.
This framework also changes investing. Instead of asking, what could 10x? Ask, what keeps me adaptable? What lets me hold dry powder? What reduces forced decisions? What protects my ability to choose later?
Those questions often lead to smarter, more durable portfolios. Some cash, some liquidity, some upside, some resilience, some room to breathe. Balanced systems outperform dramatic systems over long periods because they survive more conditions.
Optionality matters in careers too. A person with one prestigious job may appear powerful. A person with diversified skills, savings, network, and low dependence may quietly be freer. One has status, the other has leverage. They are not the same.
This does not mean avoiding bold moves. Sometimes concentrated bets create life-changing outcomes. Risk is necessary. Conviction is required. But after gains arrive, the mission shifts.
The mission becomes converting upside into durable freedom. Many fail because they continue accumulating without designing freedom. They chase numbers when they should be building systems.
Elite operators understand timing. Aggression has a season. Protection has a season. Simplification has a season. Simplification has a season. Freedom has a season. Wisdom is knowing which season you are in.
True wealth is not the size of one great win. It is the number of strong choices available after the win. Freedom compounds faster than money ever will.
The ultimate lesson: do not just chase bigger returns. Design a life that remains yours when the returns arrive.
Next segment, summary and key reflections. Segment 10, summary and key reflections. Most people measure success by the numbers, net worth, income, or portfolio size. But numbers alone do not tell the full story. Wealth can increase while freedom, choice, and flexibility remain limited.
We explored the traps that often follow big wins: illiquidity, taxes, concentration, psychology, identity, and lifestyle inflation. Each of these can quietly reduce optionality, even when your account grows.
These traps compound when people confuse growth with freedom. Just because the number rises does not mean the life you want is expanding alongside it.
The Freedom Scorecard and Optionality Framework give concrete ways to evaluate decisions through the lens of real freedom. Liquidity, stress, dependence, and time must all be considered alongside gains.
True wealth is measured not by commas on a statement, but by the room you have to act, choose, and live without constraints. Freedom compounds faster than money ever will.
Ask yourself, does this asset, job, or opportunity increase my life options? Does it create resilience and flexibility? If not, it may be contributing to hidden captivity.
The ultimate lesson of this episode is simple. Do not just chase bigger returns. Design a life that remains yours when the returns arrive. Focus on optionality, clarity, and sustainable freedom.
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit 10,000 downloads to build the smartest macro community online. We cover finance, AI, money, and mindset across 4 series, all grouped at financefrontierai.com. And if you've got a story that fits, we may pitch it in a future episode free. If there's a clear win-win, just go to the pitch page and take a look.
This podcast is for educational purposes only, not financial advice. Always do your own research and consult a licensed financial advisor.
Markets evolve, risks compound, and no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright 2026 Finance Frontier AI. Unauthorized reproduction is prohibited. AI host mapping. Sophia is powered by ChatGPT. Max is powered by Grok. Charlie is powered by Gemini.